Hi everyone, my name is Matt Crisafulli. I'm a partner at ACap Advisors and Accountants, and I put together a webinar on the CARES Act, which is the act that Congress passed the last week of March, and it was signed into law by the President the last week of March, with the underlying goal of helping the U.S. and its citizens and the economy in the wake of the coronavirus pandemic. CARES is an acronym for the Coronavirus Aid, Relief, and Economic Securities Act. And this webinar in particular is going to focus on the provisions in the CARES Act that benefit individuals and their families. So as I mentioned, the CARES Act has a very wide reach. It impacts individuals and families. It impacts small businesses as well as big corporations. There's provisions within the CARES Act that relate specifically to hospitals and public health. There's also provisions that deal with federal programs and helping programs that are already in place, as well as state and local governments. And there's also provisions that are geared to help educational institutions and students in those educational institutions. So with that being said, this webinar focuses mainly on the provisions that relate directly to individuals and families, so more on the micro level. The first thing that everyone heard about with the economic stimulus were the cash payments. So for individuals earning $75,000 or less per year, or married couples earning $150,000 or less per year, and if you happen to be a head of household earning $112,500 or less per year, you are eligible to receive a one-time payment of $1,200. That's $2,400 for people who are married filing joint. If you have dependent children, those dependents also qualify for a one-time payment of $500 per qualifying dependent child. The rules for determining who is a dependent are the same as when you're filing your tax return. So there's specific rules that qualify a child to be your dependent, and those same rules are in effect here. And as a rough example, if there's a family of 4, 2 adults and 2 children filing as married filing joint, if the combined income of the 2 spouses is less than $150,000 a year and both children qualify as dependents, that family could expect to receive $3,400 in payments from the government for this cash payment for this economic stimulus check. A couple other rules. The taxpayers must have a valid tax ID number, both the parents and the children. This is usually the Social Security number. It can be a tax ID number. You cannot be a non-resident alien, and you cannot be claimed as a dependent on another person's tax return in order to receive these benefits. Also, estates and trusts do not receive these benefits either. The cash payments are phase out, meaning they become a little bit less as your income increases between $75,000 and $99,000. After $99,000 for an individual, the stimulus check is completely eliminated. For people who are married filing a joint return, that number is between $150,000 and $198,000. And for head of household, that number is between $112,000 and $136,500. There'll be a reduced payment that's received for those individuals. There are a number of calculators online that you can use to try and determine what your economic stimulus check will be based on your facts and circumstances. And the income number that the IRS is using, or the government is using, to determine who's eligible for these checks is based on your 2018 tax return, taxable income, or 2019 tax return if it's already filed. And essentially, there's nothing that you have to do to receive the payment. They will be using the information on record for 2018 and 2019 tax returns in order to send the payments out. If you had a direct deposit of your 2018 or your 2019 tax refund, or owed using electronic withdrawal for your 2018 or 2019 tax return, those payments will be automatically deposited into your bank account. The timeline is a little bit unclear at this point, but the goal is to start sending them out the first week of April, but more realistic predictions have it the second or third week of April where people will start receiving those payments. Now, if your 2018 or 2019 tax return did not include any direct deposit or direct withdrawal using your bank information, the IRS has said they will be opening a web portal for individuals to enter their information directly online, their bank account information, their routing number, and the bank account number, so that payments can come to individuals much more quickly than with a check, which, based on past experience, the IRS said could take between 6 and 8 weeks. The goal of these checks is to get them to taxpayers as soon as possible, which is why they're going to send them out with the information they have on file from 2018 or 2019 tax returns, or they're going to open up the web portals for taxpayers to enter their bank account information directly on the IRS website, again with the ultimate goal of expediting this process. The next major provision as it relates to individuals is that the tax deadline is delayed from April 15th, the famous tax day, to July 15th. That's a 3-month extension, both to file your tax return and to pay any tax due for tax year 2019. This is an automatic extension. No forms need to be filed with the IRS to get this extension. And individuals that file an extension get extended time beyond the July 15th deadline. There will be no penalties or interest due for any tax liability owed for 2019. Essentially, the IRS and the federal government are wanting individuals to keep their money in their pockets right now to use to spend on necessities while the whole government and basically the whole economy is shut down. Starting after July 15th, on July 16th, penalties and interest will start to accrue on any unpaid tax liability from tax year 2019. But this is common. This is how it works after the April 15th deadline as well. That's just when the penalties will start accruing for in 2020. The other deadline that was moved was the estimated tax payment deadline. So for those who have to make estimated tax payments every year, those are normally due on April 15th, June 15th, September 15th, and January 15th of the following year for the fourth quarter. For 2020, the first quarter through the third quarter payments, so the ones that would normally be due in April, June, and September, are all due on October 15th this year, with the fourth quarter payment still being due January 15th of 2021. Now, normally the estimated tax payments cover the months directly preceding the due date. So for 2020, the October 15th payment is going to cover periods from January 1st, 2020 through September 30th, 2020. And the fourth quarter payment, which is due on January 15th of 2021, is going to cover the period of time from October 1st through December 31st. There are other special provisions in the CARES Act for retirement accounts. The ultimate goal of this section of the CARES Act is to give people money, access to money in the short term to help them kind of bridge the gap for this time where they might be laid off, or their company might be shut down, or they might be prohibited from working. So a few of the special rules for the retirement accounts in the CARES Act are up to $100,000 can be withdrawn from retirement accounts. It's either 401ks or IRAs, 403bs included as well, for use to help you make ends meet in the short term. Now, withdrawals are taxable, as they would be if you took them out later in your plan. but they are waiving the 10% penalty. So not only do you have access to it, but they are waiving the 10% penalty. And normally, individuals would not have access to the funds in their 401k account or their IRAs, but now they are accessible. They're making them accessible to you. Additionally, you have time to put the $100,000 up to $100,000 that you withdrew from your 401k or IRA back into your 401k or your IRA. Now, normally, if you take a withdrawal from a 401k or an individual retirement account, you're not able to put that money back in. But the CARES Act allows you up to 3 years to put the funds back into your 401k or your individual retirement account, with the idea that you needed the money for a short term while everything was shut down, but you're able to put it back in once everything gets back up and running again. Not only that, but if you take the money out and you then can't afford to put it back in over the 3 years, you're allowed to spread the tax liability generated from the withdrawal of the up to $100,000 withdrawal over 3 years, so that you can pay a little bit over the next 3 years. Another provision that was added in the CARES Act was the maximum 401k loan amount is increased. Normally, you're only allowed to borrow up to $50,000 of a 401k from a 401k. They changed that to be $100,000 with the CARES Act. And also, you're normally only allowed to loan against 50% of your vested 401k balance. So 50% of the money that's entitled to you, you're allowed to borrow against, with a maximum of $50,000. But with the CARES Act, you are now allowed to borrow up to 100% of the vested balance with a maximum of $100,000. Another benefit that they're trying to enact they enacted for the CARES Act is that required minimum distributions do not have to be taken for tax year 2020. So what that means is if you have an individual retirement account or a 401k and you're over age 70.5 or age 72, depending on your birthday, you do not need to take required minimum distributions for tax year 2020. Now, this also includes inherited IRAs. This provision was added because the stock market was hit pretty hard from the economic shutdown. So the goal is to let retirees or people who have to take money from individual retirement accounts every year, let them keep the funds in their account for now and not have to sell right after everything declines sharply in value. And the last change as it relates to retirement accounts is that the IRA contribution deadline is also extended to July 15th, 2020. So normally the deadline to contribute to a Roth or a traditional IRA is April 15th of the tax year, but this year it's extended to the due date of the return, which is July 15th, 2020. The bill also makes major changes to unemployment assistance, increasing the benefits. It increases the length of time of payments, and it broadens who's eligible to receive those benefits. So the first thing the CARES Act does is increases the amount to be paid for eligible recipients. So not only are people who are laid off from their jobs eligible for unemployment insurance, but the CARES Act adds an additional $600 per week in compensation to those people who are laid off. Next, unemployment benefits are extended by additional 13 weeks. Normal unemployment benefits are paid out for 26 weeks, but the CARES Act adds an additional 13 weeks to the unemployment benefits. For a total of 39 weeks. Now, the last 13 weeks the CARES Act authorizes are only if they are needed. So if your company starts back up and you are not laid off anymore, then the additional 13 weeks benefit doesn't apply. But if your company does not hire you back or you're unable to find work, then the additional 13 weeks of unemployment benefits kicks in. It also expands the eligibility of unemployment insurance to self-employed individuals and so-called gig workers, so your Uber, Lyft drivers, and people of that nature. Normally, self-employed individuals and those gig workers are not eligible for unemployment insurance because they don't pay into that system. But the CARES Act has a provision that allows self-employed individuals and gig workers access to unemployment insurance or unemployment benefits because of the CARES Act and because of the coronavirus pandemic. The final provision of the CARES Act as it relates to individuals that I'll be covering today is one that relates to student loans and the provisions in the CARES Act for student loans. Starting in March of 2020, borrowers are eligible to defer payments on their student loans for up to 6 months through the end of September of 2020. And during that time, no penalties or interest will accrue on their loans while sort of everything gets back to normal in the U.S. and in the economy. You're still eligible to make payments if you can afford to do so, and interest will still not accrue even if you're eligible and even if you are capable of making payments during this shutdown period of time. There will be no interest accruing on your accounts during that time. For those in loan forgiveness programs, such as the Public Service Loan Forgiveness Program, any payments made will still count towards your monthly payment total goal in order to receive that forgiveness. But if you do not make payments, so if you elect to not make payments for the 6 months between now and the end of September, those payments do not count towards your total monthly payment goal. However, if because of the economic shutdown, you are making less money and your income has declined, you are eligible to recertify your income mid-year. Normally, when you are in one of the loan forgiveness programs or income-based repayment programs, you have to certify your income once a year, and that's what that year's payments are based on, that the prior year's income. But because of the CARES Act, you're eligible to recertify mid-year and reduce your payments, and those reduced payments, if made, would qualify towards your monthly or your total payment goal to reach those forgiven amounts for either income-based or a public service loan forgiveness program. And finally, the other benefits are for current students who are on work-study programs or who are receiving grants. So the CARES Act allows universities to continue paying students for work-study even though basically the universities are shut down and nobody's working. And it also waives certain requirements for students who are receiving grants and other educational assistance who would normally have to be meeting educational time and unit requirements. Those requirements are being waived. The government is allowing universities to waive those requirements and not penalize the student during this shutdown. That concludes the presentation on the CARES Act and the provisions of the CARES Act that relate to individuals and families. I hope you found it helpful. Please make a note that new regulations and new guidelines and new clarifications are coming out from the federal government and the IRS on a daily basis because all of this is so new and so dynamic. And also be aware that certain provisions that make sense for you to take advantage of are not going to be the same for somebody else. So it's important that you consult with your trusted advisors to see what makes the most sense for you and your individual and unique circumstances. There's our contact information if you guys want to reach out to us. Thank you for joining. I hope you found this information to be valuable. And if you have any questions or comments, leave it in the feedback section and we'll do our best to respond.